I don't want to call it a disaster, but when dealers won't take that vehicle on trade, you know it's a flop.
Most automakers have had trouble selling as many cars as they did in 2019, but a few brands have managed to rise above the rest. Today on the Car Dealership Guy podcast, I'm speaking with Alan Haig, founder and president of Haig Partners, a dealership buy-sell advisory that helps dealers sell their businesses. Don't forget to click subscribe so you never miss an episode. Before we get into the show, this episode is brought to you by Impel. A word of caution to dealers: open source GPTs are conversation tools, not business solutions. If you want to embrace results, not risk, choose AI that's designed for automotive retail. With Impel AI, you can drive real results throughout the entire customer journey. From website, chat, sales, and service, Impel AI is custom built to achieve your business objectives. It features a proprietary blend of large language models, automotive optimization layers, and seamless integration with your entire tech stack. The result? Exceptional customer experiences and increased customer lifetime value, and that means more revenue and greater profitability. Embrace results, not risk with Impel AI. See what the future of AI looks like today. Visit impel.ai or click the link in the show notes below. This episode is also brought to you by Auto Hauler Exchange. Auto Hauler Exchange is changing how vehicle shippers and carriers can connect and work together. Now, if you need to ship a car, you can work with carriers all over the country directly. And if you transport cars, you don't have to look through brokerage boards to find good, fair jobs anymore. By eliminating the middleman, all shipments on Auto Hauler Exchange come directly from the owner of the vehicle being shipped, with carriers receiving real shipment opportunities at direct pricing. Auto Hauler Exchange helps shippers and carriers work together easily and clearly, adding transparency and making better partnerships. Get off the auto hauling roller coaster by getting on the Auto Hauler Exchange. To learn more, visit autohaulerexchange.com or click the link in the show notes below. Lastly, this episode is also brought to you by Haig Partners. I'd like to thank Haig for coming on as a guest and also supporting this podcast. Alan Haig on the CDG podcast. Alan, welcome back.
Thank you, Yossi. It's good to be with you again.
It's good to have you back on. I was gonna start by asking you about the industry, but I think the conversation we had before I even started pressing record is even better. I mean, having a good old conversation with you about marriage, weddings, relationships. So, not the direction I thought we would take to start this pod, but I love to hear it.
Well, I think that one aspect of our industry that's unique is that many of these businesses, the vast majority of them, are owned by families. And families have moms and dads and sisters and brothers and sons and daughters and cousins. And that makes our lives richer, trying to give people advice on buying and selling, and also ties us a little closer to our clients because we're a business in which we have some family members working now too. Two of my sons joined about a year ago. My wife has been our CFO since we formed the company. But regularly when we're talking with people that are thinking about selling, it's often family matters that are the decision makers. And even for folks that are buying, often it's a family decision about whether to invest or not. So it's a big part of our daily lives, even though we deal with a lot of numbers and legal documents, et cetera. At the end of the day, it's almost always a family decision about exiting or growing. So it makes our lives a little richer and sometimes more complicated.
I bet. I know a thing or two about a family dealership business. So been there and experienced the ups and the downs. So
that's right, you have.
Definitely keeps it interesting. For those that have not, or for our new listeners on the podcast who have not yet heard from you, and I think one of the things I love about you is you bring such a well-rounded perspective to the podcast, given your experience and what you're doing, daily in the field and exposure to such a wide array of dealer groups. But give our listeners a brief background on you for our new listeners who have not listened to your prior podcasts.
I grew up, my parents were both teachers, and I started my career in New York doing investment banking, and I was scared every day going to work because I really wasn't qualified for the job that I've been given. And I knew after working in finance that I also wanted to have a chance to work in a real company, one that had products that they sold and customers, employees, et cetera. So after I got my business degree, I went down to work for the Huizinga family of companies here in Fort Lauderdale. And Wayne's known for waste management. He's known for Blockbuster. He's also known for AutoNation. And I was hired after we sold Blockbuster to Viacom. I was hired to write a business plan on forming a new car division to accompany the AutoNation used car superstores, which were under development. So I didn't know anything about the new car business. So I went and did my little MBA research and put together a business plan that called for rapid consolidation of the automotive retail industry. We would have economies of scale that smaller dealers wouldn't have. We'd have national brand that we could use to leverage our advertising dollars. We would deploy the best practices throughout our dealership chain so that we could operate highly profitably and take share without having to buy it all and please the factories. Basically, we got it approved by the board and they said, go start acquiring dealerships. I didn't know a single dealer, so they teamed me up with some people from Southeast Toyota, and we started acquiring dealerships. And AutoNation went from 0 dealerships to over 400 dealerships in a few years. But much of what I wrote didn't come to fruition. It almost all fell short of the plan, the hope, because we realized we didn't really have anything that an entrepreneur didn't. We didn't have better practices on average than entrepreneurs. The consumer didn't care about our scale. In fact, there really were almost diseconomies of scale. We couldn't buy the products any cheaper, new or used. We couldn't buy real estate cheaper. We couldn't pay less for real estate. Couldn't pay less for utilities, maybe a little bit less for technology insurance. So we didn't have any economy of scale, but we sure had a lot of overhead. And what we learned is some of the businesses that we were buying, which were very high performing businesses, when the entrepreneur stepped out of the store and he was replaced by the best general manager that we could find to fill his role, often the performance dropped and sales maybe went down a little bit. Maybe customer service wasn't quite as good. Maybe the customers weren't as happy with the experience. And so then the factories started to push back and say, hey, if you can't run these as well as the last guy, if you can't hit your sales goals, if you can't hit your CSI goals, then maybe you shouldn't be buying more stores. And so I think that's a lesson that I really learned early in the business, is that our industry does have some economies of scale. There are some best practices that absolutely exist, but the entrepreneur is still the key to success, in my opinion. And a guy with one store can outsell and out earn the largest auto retailer if he's there every day caring about his people and his customers.
Why is the entrepreneur so important to the local dealership model, in your opinion, nowadays? Like, why has that not gone away when we have all these massive retail establishments and technology which standardizes things? How is it to this day that there's so much? I don't know if I want to call it key man risk, but in essence, I mean, if one person that's so key to the to the ethos of a thriving dealership, why is that?
It's people inside the building and it's people outside the building. Again, going back to my days getting my MBA, I don't think I took a single class where it talked about quality of employees. Employees were just like a commodity, like water or electricity. It was just you get hire labor and you increase production. But there's a difference in the quality of the person who works for you and how they perform their tasks. So we had the pleasure of representing a couple, Jack and Robin Saltzman, on the sale of their Stellantis dealerships a little over a year ago. And Jack and Robin put everything they had into buying those stores back in, I forget when it was, in the 90s perhaps. And during the Great Recession, they almost lost them because, sales were dropping. Customers couldn't afford the cars. And so they nearly went bankrupt. And in fact, they were told by their landlord, you should go out and hire bankruptcy counsel right now. And they said, no, we're not doing this. They shoved all their chips in. And when I asked them, what were the keys to success, and they were paid the highest value ever paid for a Stellantis dealership. That was just over a year ago. It's amazing to think about what happens to Stellantis since. We can talk about that later. But when I asked, like, well,
Pretty
what were
timely.
the keys? Yeah, they said the three things that they really emphasize to people coming up are work harder than anyone else, bet on yourself, and treat everyone like your family. So they were going to work every day, walking in the same door, going in the service drive, going to the sales tower, going to their offices, every day trying to satisfy customers, trying to attract and retain people. And that's difficult for anyone who's a paid employee to match that amount of commitment, passion, care over 20 years or however long they own those stores. So that passion, that energy, that commitment to your family business is something that's very difficult, I think, for a public company to hire a general manager to get that out of their people.
You know what's interesting? When the more I got exposed to the large dealer groups, and we're talking, in the billions and whatnot, the more I was initially shocked at how decentralized some dealerships are, meaning how much power and authority a single general manager has, even under a large, multinational dealer group. It's just not something that I expected before I knew that these people, these GMs, have so much power over the dealerships that they're operating. And it feels to me as though it's unlike any other form of retail out there, right? Go to the biggest Walmart in America. That GM, yes, sure they have some power and all that, but they don't have. I mean, they're governed like crazy, right? They're in a box. They can only do so much. Go to a large dealership. That GM has, it really is in a way like their own business where they really can make intimate decisions. Now, that changes dealer group to dealer group clearly, but I was pretty surprised initially when I learned this because I always assumed early on that, hey, of course, massive dealer group, everything's going to be centralized and the GM will just be, like a pawn, but it's definitely not the case in this business. So that's just something that surprised me when I first learned about it.
It's true. I think it's been, as the public companies came in, and I experienced this a little bit when I was at AutoNation the second time. I was there twice in my career. And the second time I came back, AutoNation had a couple large institutional investors. And one of them was a hedge fund, Eddie Lampert's hedge fund. And Eddie made a very smart investment. He bought AutoNation stock at like $4 a share or $6 a share, something like that, when it was a low point. And as he got more involved, I think he started to look at the compensation paid to general managers. And he realized that some of the GMs who were running one store were being paid more than like the CFO at Sears that he also controlled at the time. He said, this is nuts. These guys have got a P&L. Maybe they're making $75 million in revenue. How can he be paid more than the guy who's getting, making financial decisions for a multi-billion dollar retailer that has thousands of locations? So I think that AutoNation and maybe some of the other companies too tried to reduce the amount of complexity for the job of general manager and therefore reduce the compensation. Say, if we pull away ordering inventory, or if we do the advertising, or if we come up with the pay plans ourselves, then we're doing that at the corporate level and he doesn't have to do it at the local level. So maybe we can squeeze that comp down. And I would argue that the best performing retail groups, and there are some excellent performers out there, have reached a balance where they say, I'm going to give the GM latitude to order inventory so long as it's selling. I'm going to allow him to advertise so long as it's not too much. I'm going to allow him to pay his people as he wants so long as he stays within certain metrics. And then he can be truly responsible for his P&L. If I do everything for him, if I order cars, price the cars, compensate his people, you can't really hold him responsible for the performance of his store because he didn't make those decisions. You did. So the groups that I've seen are the ones who say, I'm here. We've got this great dealership. Maybe I'll loan you money to buy into it. So you're an equity partner. That's a model that I've seen some of the most successful retailers adopt, where they're selling perhaps 20% equity to the general manager. So now he's invested literally with you. You believe he's going to be committed to stay with you for decades, hopefully. You let him run the business as he sees fit, so long as you're getting market share, so the factory is happy, so long as customer satisfaction is good, so long as he's not taking any big risks that could hurt you if he were to leave. So as long as those conditions are met, you stay in that box, run the business. And that, to me, is the model that I think works best. I wish the public companies could find a way to offer equity to their general managers, because I think if they did, it would really transform their businesses for the better.
Yeah, and when you say that, you're referring to equity at their actual store, not equity, of course, in the parent company. As you were saying that, I was laughing or smiling because I remember when I initially raised venture funding for Get a Car, and we were starting to, we brought on a CFO, starting to really clean things up, and just become professionalized. Right, you raise funding, so we instituted pay bands, and I remember the friction between corporate and operations, right? When you have a sales manager or the dealership GM making 200,000 plus, 300,000 plus, whatever, and suddenly you have a CFO in a startup making less money than that, or close to the same, and it's like it was people were like not understanding. They're like, wait, this is operations making this much money, and now start explaining to someone who's not from the industry that yes, it's actually totally normal. This position in a dealership is a 200,000 or even $300,000 plus position annually. That caused a lot of friction.
Comp is one of the hardest things in our business. The ones who I see do really well, they've come up with a formula. It's a pay plan. You get X% of the gross profit you generate. So the more you generate, the more you get paid. It's just that simple. Most people didn't change their comp during the pandemic, even though people's earnings probably tripled. We're selling a truck dealership group right now. One of his salesmen made over $2 million last year. That's not the general manager. That's a salesman.
Wait, where is this? Where is this?
This is in the central part of the country. I'll put it that way. And so
and what type of dealership is it?
Freightliner. So this is a heavy truck group. So he found some clients and he was able to sell them a lot of trucks at a nice gross profit. And my client was happy to pay it to him. We talked about maybe treating that as an add back because it was so exceptionally high. And we said, we can't. That's legitimate comp. He earned it. It's something that should be paid, and it may not be repeated. We'll see if he does it again. But that to me is kind of part of the fun about this business is that it really is a meritocracy. If you're working at a dealership, if you're a great salesperson, doesn't matter if you're 20 or 80, what race you are, what weight you are, what your educational level is. If you're good at taking care of customers, you can make a lot of money and have a great career.
This episode is brought to you by my very own car dealership guy industry job board. CDGjobs.com, my industry job board connecting the best talent in automotive with the best companies, will remain absolutely free for CDG listeners to post and fill available roles at their companies. This free job board is for anyone in automotive, vendors, dealers, lenders, manufacturers, auto tech, everyone. Already, over 100 companies have posted open positions, including Lithia Motors, Recurrent, Credit Acceptance, Veros Credit, Cars Commerce, Shift Digital, Plug, Fullpath, Westlake, Trade Pending. You get the point. The best part is that when these companies hire through cdgjobs.com, they are hiring the most informed candidates in the marketplace. So don't hesitate. You can add your open roles today by visiting cdgjobs.com or clicking the link in the show notes below. That's cdgjobs.com. Before we get into the broader car market and all the moving pieces, there's so much change happening right now. You mentioned Stellantis. We'll talk about that, buy, sell. Tell me, what are you seeing on, you mentioned becoming like an operating partner. You mentioned opportunities, for GMs to get ownership. Give us like a little behind the scenes look into some structures that you're seeing in our market nowadays, right? What's changing? What's happening with opportunities for employees in this industry? As specific as you can, what are you seeing out there?
Well, the dealership values tripled during the pandemic. So it became difficult for the historical transfer of ownership where it went from from a dealer operator to his general manager. Sometimes the dealer would finance the GM. That became almost impossible to do when dealership values were $10, $20 million in goodwill per location. It's just very hard to transition that to a GM. So I would say that the opportunities for GMs to buy out and become 100% owners has declined over the years as dealership values have gone up. But we still see, and I don't know what percentage it is, Yossi, we still see that maybe half of the folks we work with that have privately owned dealership groups have equity partners. And there's a lot of nuances in them, but basically they'll say, okay, the blue sky value of this business is, let's say, $10 million. So if you want to buy in 20%, that's $2 million in cash you have to come up with. If you don't have $2 million in cash, I might loan you 50%, 80% of it, whatever. There's some folks who say you've got to invest every last nickel you have. You have a bass boat, you sell it. You have a lake cabin, you sell it. You got a portfolio of stocks, you sell it. I want to see you fully committed into this business, and I'll finance the balance. So now that dealership owner knows he has the commitment of that GM, and the GM that just shoved all his chips in there for sure is going to be going to work and busting his tail to make sure that the store performs well. So
Alan,
then,
define blue sky. Define blue sky for anyone that doesn't know what that means.
so from an accounting standpoint, it's an intangible asset. If you buy a dealership, there's the real estate component. Then there are the tangible assets like the vehicles, the parts, the furniture, fixtures, and equipment. Then, because that business generates profit, when someone wants to sell it, there's also a price to be paid to buy into the ownership. And that price is called goodwill or blue sky. They're both the intangible asset, what something is worth above the physical assets. And it's often a multiple of pre-tax earnings that somebody expects the business is going to make in the upcoming years. And it varies based upon the franchise type. So people will pay a higher multiple of earnings for a brand that they think is going to be growing faster or is very stable, like Toyota. And they'll pay a lower multiple of profits for a brand that maybe has some risks, which today I would point to Nissan is an example. So the GM now has an opportunity to buy into that business. I believe that increases the work ethic for that general manager. I think they feel that they can make long-term decisions that are in the best interest of the business. They're more likely to say to the majority owner, hey, we need a new roof because this thing is leaking a lot, versus if I just were there and had a job, I would just put a bucket in the corner, to catch the rain when it came in, so that I didn't have to pay for any maintenance repairs out of my P&L because they get a percentage of the profits. So I think it encourages better long-term decision making. I think the GMs were going to recruit better talented people. I think that they're going to treat those people better because they are going to be hoping to work with them for decades, not months, which often happens if there's a lot of turnover in a store. So if you could buy into a store and you can be there for 10, 20 years, let's say the dealership's making $2 million a year. So you get your compensation as the general manager, but then you also get a compensation for having a cut of the profits. So many people that we see that have been partners of stores have been making seven-figure incomes from their compensation pay plan plus their ownership percentage. And you do that 5, 10, 20 years, you create generational wealth for you and your family, right? And so there are very few opportunities that I know of outside of auto retail where somebody can come in at the entry level and have a good chance, if they work hard and do well, to become a millionaire by the time they're 40 or 50 and be worth tens of millions of dollars by the time they want to retire. That's not common in my experience in any industry.
Yeah. Yeah. I just had Julie Herrera on the podcast, and, phenomenal story in episode 30 years in the business, but really took that playbook and started from nothing, built up just a conglomerate, Toyota store owner, just incredible journey. I want to transition to a very high level overview of what is currently happening in the market. Where are we at right now? When I say the market, I'm referring to the broader auto market, but with an emphasis on the dealership buy sell market, which has been, a very, very good proxy for the health of our industry. So hit us off. Where are we at right now?
We're in a very good spot, but it's coming down. Dealership profits peaked 22, I think it was. We had a remarkable increase in profitability. I think it ran up over 3 times the levels it was before the pandemic hit.
What was it? What was it in 22? When you say they peaked, where were we at in 22?
So when we estimate the average blue sky value, again, for dealerships, so excluding the tangible assets like inventories and furniture and things like that, if we just look at the intangible, that's what's gone up and down along with the profits. We looked at the data published by the publicly traded retailers, and we estimated that the blue sky value per dealership they owned prior to the pandemic was around $6 million. In 2022, it was over 25. So it more than quadrupled, really, because the shortage of inventory led to a lot of positive impacts at the dealership that led to a significant increase in profits. So you had higher front end gross profits on new, higher front end gross profits on used. You had lower advertising costs because dealers didn't have to promote vehicles to get them people come in. People were coming in already. You had lower floor plan expenses because you didn't have vehicles sitting on the ground very long. They were coming in and going very quickly. And you didn't need as many employees to sell the fewer cars that were out there. So it was a perfect storm of goodness for dealers during the pandemic. Now, we all knew that was temporary. We all knew that the computer chips would return, employees would go back to work, production of new vehicles would resume. And that's the story that we're experiencing now, is that productivity has returned faster than demand in some cases, because we had a lot of customers that wanted to purchase vehicles that couldn't because they weren't available. Now we're having a lot of customers that are having a hard time purchasing vehicles because of affordability. The factories increased their prices on their products significantly, maybe as much as a third during the pandemic, far in excess of inflation. And interest rates have gone from historical lows to historical highs to help offset inflation. So the average consumer is now under pressure, even though they're making more money, their wages have gone up. They haven't gone up enough to offset the big increase in vehicle prices and monthly payments. So there's a little bit of a tension where now the OEMs are producing cars again at pretty high levels, but the demand is suppressed because of high interest rates and high costs. And the result is inventories are building, and to clear lots, dealers have to cut prices and they have to advertise more. And because their inventory is turning more slowly, their floor plan interest expense are going up. So when you now we have the reverse happening of what we happened at the beginning of the pandemic. So dealership profits are falling. We estimate they fell in the fourth quarter of 2023. They were down 31% from the peak, which was the fourth quarter of 22. So big drop in profits, or excuse me, that's 23%, not 31, 23%. But we're still 78% higher than the fourth quarter of 2019. So we're down off our peak, but we're still way over where we were before the pandemic hit. So dealers that we speak with are still pretty happy. I think they all knew this time would come when the pendulum would start to swing back. Now the big debate in our minds and the minds of many dealers is it going to swing all the way back? Are the factories going to go back to their overproducing ways? And will that crush margins and push up advertising costs and push up floor plan interest expense? Or will some lessons have been learned that less is more? If we look at some of the most successful brands out there, I'm going to point to Porsche and Subaru. The factories and the dealers and the consumers have benefited by having one fewer unit supplied than what is demanded. When I say all of them benefit, because the factories win with more demand than supply because they have fewer incentives. They don't have to cut the margins. They don't have to advertise as much. The dealer benefits because of the same reasons. He doesn't have to cut his price. He doesn't have to store the inventory. He doesn't have to advertise. And the consumer benefits because the residual value for that vehicle they're purchasing is higher in 1 year, 2 years, 3 years, 10 years than if he bought a vehicle from a company like Nissan, that overproduced. And then the residual value goes down a lot, or the domestic brands suffer from that too. So that's the win-win-win that I feel that the OEMs should have learned. Question is, will they have learned it, or will they fight for share?
Well, to be devil's advocate there, right? One person does lose, and that is the consumer that has not bought a car. In theory, right? Because based on that logic, that consumer will be paying more for the next car they buy. Fair?
Yes, that's fair. I guess it can't all be perfect in life. I think that they also will benefit though, because when they buy that vehicle, there'll still be less depreciation when they own the vehicle. When you have so many cars getting produced, the value tanks for everybody. Everybody's suffering from that decline in residual values. So if there are fewer units in inventory, if I buy units 3 years old, I should have less diminution of value over the next 3 years than I would if they're just flooding the market. So they would have to pay more to get that used vehicle, but then they'll suffer less depreciation during their ownership life cycle as well. So I think it works out best for everybody.
Yeah. I think this is a perfect segue into Nissan. I want to do a bit of a brand by brand breakdown here because there's several brands, as one person recently said to me, independently box. And so I want to start with Nissan, which is really a name that we did not discuss last time me and you sat down to have a discussion. If anything, we discussed it in a positive manner. But Nissan has been changing some things up lately. Give us the overview on Nissan, where they're at right now, what's happening.
I feel bad for our friends that have Nissan dealerships. I feel like they have been battered children in the relationship with their supplier, kind of their parent. During the Carlos Ghosn era, there was a lot of push in the system. Carlos Ghosn was pushing for, it was 8% market share and 8% pre-tax margins. So he wanted volume and profit. And he pushed his dealers to take a lot of cars and had stair-step programs where if your target number was fair, your stair-step program was fair, you can make a lot of money. But every month, the leading dealers that I talked to had their target raised. So if they had a great month, great, you made some money. Next month, it was even higher. So they got on this wheel, like a hamster wheel, where the faster they spun, the more they sold. In some ways, the harder it was to make money. And the consumers suffered because if you bought a vehicle at the beginning of the month for $30,000, they were selling that vehicle for $27,000 at the end of the month to try to hit their numbers. And then Carlos Ghosn got, charged with these crimes from Nissan, and the business collapsed prior to the pandemic. Dealerships were having a hard time selling any cars. There was no incentives. There was no marketing. The product was getting stale. The pandemic was a bit of a godsend for many Nissan dealers because they had massive inventories that were aging. But when the pandemic hit and there was no production, they were able to clear out all those inventories. Great. Then now we're getting past the pandemic. You kind of want to have some more production again. And it doesn't come very fast. The products are not that compelling to customers. Now they're in a position of overproducing. And they're coming out, particularly with these 24 Rogues. There's still a bunch of 23 Rogues that are sitting on the ground. There's not enough incentives to clear them out. And dealers are saying, I can't take any more. I can't take any 24s until I get rid of the 23s. And the consumer's like, I don't want a 23. I'd rather have a 24. This is an old unit. So they create a problem for themselves again. I also read that in January, I think Nissan sold 44% of its volume to fleet operators, to rental car companies. Those rental car companies are going to do what they always do, which is keep the car for maybe 6 months, maybe a year. They're going to dump it. So in 6 months, a year now, there's going to be this big influx of used Rogues and Sentras into the market that's going to depress the value of all the consumer vehicles that were just purchased. So
that's where I wanted to dig into, right? Like, what does this all mean at the end of the day, right? Well, number one is the vehicle that you own and the vehicle that the dealer currently owns and wants to sell is officially, once there's a lot more supply in the market, that will now be worth less when you go to return that lease or you want to sell that car. As a consumer, my calculation is different because if I thought your vehicle that you're selling me was going to be worth $15,000 in X amount of years or $20,000, it's now going to be worth less than that, right? So I'm going to be willing to pay less or I'm getting less value.
And what does that do to your loyalty to that brand? If you bought a vehicle and it depreciates faster than a competing vehicle, the next time you're ready to purchase, are you going back for more? Or are you going to say, maybe I'll try a Toyota this time or a Subaru? I heard that the depreciation curve is less. Even if I have to pay a little bit more for it, maybe it's worth it. So that's what I mean about my friends that were Nissan dealers. I feel like they're battered children where they're trying hard. They show up every day. They open the doors. They pick up the paper that's on the floor. They hire the best people they can. They sell the vehicles that they're offered. But the business model that the factory is running is a lot less successful for the dealer and the factory, in my opinion, than the one that Toyota is running, or Subaru is running, or Porsche is running. Sometimes I feel like saying, just copy Toyota. Just copy them. It's proven it works. Why do something different? And it may take a while to perfectly copy. You might not get there.
When you say just copy Toyota, what does that really mean to you?
I think in the Toyota DNA, there is a long-term perspective about product development, about how it impacts the consumer. And it's not just Toyota. I think, Honda probably feels this way too. But one thing that makes Toyota unique is that they believe their retailer, the dealer, is a significant advantage in their ability to compete in the marketplace and win. So they give a lot of support to the dealer. They don't try to punish the dealer, which I think some factories tend to do when success happens. So Toyota will have not so many, the throughput per Toyota dealership, sales per Toyota location is higher than any other brand. That means that Toyota dealers can make more money. If I make more money, I can have the best real estate. I can have the best marketing. I can have the best general manager. There's a phrase that Mike Jackson used to say, that there's a war for talent and capital in automotive retail. And if I have a business model that's high volume, allows the dealer to make a lot of money, then I'm going to get the best locations and the best people. And it becomes a virtuous circle. They also have never pursued, to my knowledge, any policies like the agency model, where they're going to try to sell cars direct. They've never been talking about creating a new sales channel for different brands. When they came up with Lexus, they sold it through dealers. When they came up with what's the brand that's gone now, where there's lower price cars? Scion. Thank you. They sold it through the dealers. Compare that
sold
to
a lot of those.
Okay, so compare that to what Volkswagen's trying about doing now with Scout. Where they're saying, we're not going to necessarily sell that through the dealer. We may come up with a different sales distribution channel. Maybe it'll be direct to consumer. That's the kind of thing that I feel like, if you could knock them on the head a little bit and say, just copy Toyota. Put that vehicle in your existing dealer's hands. They will do a great job selling it. They need the volume, and they need the margin, and they need the fixed ops. So here's where, if you just copy Toyota and you do things that are in the long-term interest of consumers and the dealers, you're going to win.
This might make you chuckle, but someone close to me recently spoke with a prominent dealer's son, and the dealer's son said that they're just trying to milk out every dollar from the dealerships for the remainder, decade, or who knows, even 2 decades for what it's worth, because they don't think they're going to be here in 30 or 25. I mean, your guess is as good as mine, but basically they don't think they'll be here at some point. What are your thoughts on that?
So it's a good question. We have had some clients who believe that the threats are sufficient enough for them to say, I'm out. I'm going to take my chips and I'm going to go invest them in other industries or public securities, diversified set of assets. So no matter what happens, I'm going to be fine. And that's a logical choice. Diversification creates certainty and reduces risk.
You're so freaking calculated. Like, I love how your response is so calculated. Anyway, I don't want to cut you off, but go ahead.
Yeah, no, it's true. I mean, you're not going to make the same cash on cash return, from owning a dealership if things continue as I hope. But this is a question I asked myself, Yossi, because I mentioned two family members who joined recently, and I asked myself, if they come into this business in their 20s, they're going to give up a career in a different industry, and at some point they won't be able to go back. So they're kind of burning their bridges to come over and work at Haig Partners and sell dealerships for their living. So do I think that dealerships are going to have value in 30 years, 40 years, when these guys, are at the end of their careers? And in the end, I decided I think they will. I think they will. I think the dealership business model, it's been around for 100 years, I believe, franchise dealerships. I call them the cockroaches of retail. No matter what gets thrown at them, whether it's public companies, whether it's the internet, whether it's a pandemic, whether it's a recession, on average, dealerships have remained profitable through all those threats. And in fact, in 2023, they had record profits because of a pandemic. I would never have guessed that a global pandemic would have created a gusher of wealth for those in the industry, but it did. Now, will it continue this way? No, it'll go back towards where it was. And I'll give you an example. There's a train system in South Florida. It's the only privately owned rail network in North America. Maybe, I don't even know if it was one Europe. And it's called the Bright Line. The nickname for it is the Red Mist by its advertising company because sadly it hits so many people and literally so many deaths on this rail line. And the cars are mostly empty. The buses that run around, mostly empty. Roads full of cars. People during the Great Recession gave up their houses, but they kept their cars. They threw the keys back to the front door. They moved out. They gave up their $500,000 home, but they kept their Toyota Corolla because cars are freedom. Cars are freedom. So I do not think that cars are going to go away. We're not going to have the ability to transport ourselves without these vehicles. And as many of the new entrants have shown, whether it's Fisker, Rivian, the best way to sell these vehicles to consumers is through the franchise dealership model. Tesla is an anomaly. Tesla received tens, if not hundreds of billions of dollars of subsidies from the government, including us paying $7,500 for every Tesla purchased, right? That's not sustainable. But for every other factory that's been successful over the long term, it's been by selling a car or a truck through a franchise dealer for a lot of reasons. They can handle the trade-in. They can arrange the financing. And a lot of customers need help getting financing. And specialty financing is maybe 15, 20% of the business. But most people need some help when they're financing or insuring a vehicle. And then when the car breaks, and it will, there's a dealer within 5 to 10 miles of most people. You can take your car in that day and probably get it back the next day. The consumer experience with Tesla, for instance, has been far different. You take your vehicle in there, they don't have extra parts. Who knows how long it's going to be to get it back? So I think over and over, there have been risks that have presented to dealers. And I was one of them back in the 90s when I wrote that business plan about how public companies are going to take over the industry, right? They've all proven to be hollow threats. And I don't want to say there are no risks in our business, but the diversification of the business model for a new car dealer, where you can sell a new car, you can sell a used car, you can provide finance and insurance, you can repair that vehicle, you can service that vehicle, you can replace a bumper or a fender if it gets in an accident. The diversification of all those different businesses yields a consistent and highly profitable business that I think is going to be here for decades to come. And therefore, when my kids expressed interest, I said, so long as you are working hard. I'm bullish. Yeah.
Talk to me about the most improving brands, right? What are you seeing out in the market where you're saying, what is the 1, 2, 3 brands that are simply operating and performing the best in terms of improvement?
Did you ever play Monopoly when you were growing up, Yossi?
I did.
I lost so many times until I realized that the key is whenever you land on a property, you buy it. You don't save your money for the blue one and not buy the yellow one, right? So my advice is, if you're a dealership owner, whenever a Toyota comes up that's in your area, you buy it because it's such a great brand and it's going to be a great brand. It's a great partner for the dealers, et cetera. So that's not necessarily an improving brand. It's always been good, but
correct.
Frankly,
That's already been good. Yes.
So no newsflash there. The two brands that have probably improved is more than any others in terms of profits and probably goodwill values as well are Hyundai and Kia. The sales performance that they enjoyed during the pandemic was exceptionally good. I guess they didn't cancel their chip orders like every other factory did when the pandemic hit. And the product quality is also dramatically improved. I used to think about Hyundai being an Elantra or, something that's kind of a basic transportation. Now the vehicle quality they have and design, the Santa Fe, the Telluride, I get the Kia and the Palisade. I guess it's the Palisade, right, at Hyundai. They're beautiful. the designs in there are as nice as any you're going to see. So those brands have increased significantly in their profitability and their desirability over the past 4 years. A sleeper brand, I would point to Mazda. And, Mazda for many people has been a low margin, low profit kind of vehicle. But the last 5 years, my eyes have been opened because on the margin side, if you have a facility that meets their image requirements, I think there's as much as 12% gross margin in a Mazda if you're selling it. If you go into a Mazda dealership, you'll think you're in a luxury dealership. The design is really nice. It's
Really?
pretty. Yeah, it's. I think it's a very pleasant place for customers to go, and their sales per location have probably improved more during the last 5 years than most other brands. In fact, I'll look that up while we're talking. And they also have a partnership now with Toyota, where Toyota Financial Services are able to provide financing to Mazda buyers. That's a huge advantage that they didn't have before. Mazda, before the pandemic, Mazda dealerships were selling about 490 cars per year per location. Now they're selling about 650. So that's a significant improvement in sales per location. And so once you get up, closer to 800, 1,000 per market per location, and you're getting 12%, that's like a little luxury store. And the multiple on those stores is quite low because no one thinks about, when I grow up, I want to be a Mazda dealer, right? You think I want to be a Mercedes dealer, a Lexus dealer, or Toyota dealer. But for people that are starting out in the business, and Yossi, I know you have a lot of folks in the independent industry, I think it's a great first franchise. It's often neglected by a group if they have 6 or 8 or 10. They put their worst talent in the smallest one. Maybe it's the Mazda store. So it's underperforming its potential. But if you buy that business and you give it the love that it deserves, I think you'll do well. So those are brands that maybe are kind of obvious and maybe one that you hadn't thought of.
I had CJ Wilson on the podcast, and he started with a Mazda. I'm pretty sure. I mean, today he's got Porsche, Audi, BMW, but he started with a Mazda.
And then 2 other brands which are a little bit higher risk but could be high return. I go back to Nissan because historically they've been the number 2 Japanese or number 3 Japanese producer. Now they've been passed by Hyundai, Kia, but I still think that DNA and that desire to do well, and they have this partnership with Renault still, and they're partnering with Honda on EVs. So I still think they could come back if they just come up with a basic retail business model that's long-term focused and is a win-win for the customer and the dealer. I think the factory will win too. And perhaps Stellantis. I mentioned that it was only a year ago where we set the record for the most money ever paid for Stellantis dealership.
What was that? Did you guys announce that number?
We haven't announced the number. It's a private figure. It was substantial. It was a 9-figure number for the whole transaction. I won't say for that particular dealership, but since the pandemic hit, somebody decided that Jeep was going to become a luxury brand. And so was Chrysler, and so was Dodge, and so was Ram. And they jacked their prices up maybe by a third. I think more, the wholesale prices for Stellantis went up maybe higher than any other franchise.
50%. 50%. Yeah, Stellantis raised their prices 50% since 2019. And, I sat there one day and I asked myself, why introduce a luxury line? I mean, these are competent individuals, right? There's a lot of smart people working at these companies. And the only conclusion that I arrived to was someone miscalculated just the economy and where we're going to be over the next couple of years, and will interest rates stay low? I can't think of any other reason why, you would push so aggressively into the luxury space and just raise prices so far up. Unless you think that, the rates at the time would stay low, and, which I'm not necessarily saying that that's a terrible prediction at the time. I mean, I don't think anyone expected rates to jack up that quickly, but making such a steep long-term move, right? This isn't like changing an image on a website. This is production, factories, year design. I mean, you're talking about years of design production cycles. It feels a little careless in hindsight.
Don't know what the rationale was. I know a little bit about retailing and other industries. It's extremely difficult to go from a mass market brand to a premium brand. Not that many people make that journey. Sometimes you can take a premium brand and bring it downscale, but it's really hard to go the other way. So I don't know what their strategy was. Perhaps they maybe they felt the Chinese brands were going to come and they had to move up market, but they have really put themselves in a tough position. I mean, we have a client now. We did a valuation on his business a couple months ago, and he's got an excellent brand and he's got Stellantis. And when we looked at his inventory, his new vehicle inventory, he had an 8.5 month supply of Stellantis product. And we said, "Is this number right? Like, how could it be this?" And he goes, "Well, I finished my Jeep showroom. I built a new facility for them, and if I did it, I was supposed to get an extra, I don't know, it's called 500 vehicles of allocation. So the day I did it is the day the trucks started showing up, and they gave me 500 all at once because they had tons of inventory they couldn't sell to other dealers. So they raised their prices. The market didn't respond properly, right? People decided, I used to be able to buy a Wrangler for 30,000. I don't feel like spending 50 on that unit now. And so dealers are suffering and the factory's suffering because dealers are not ordering new products. They got to get rid of this inventory they have. Fortunately, just recently, the incentives have increased enough so that inventory is getting cleared out. Because I was afraid, hey, at closing, what are we going to do with 8 months supply of Chrysler minivans, and Jeep Gladiators? That stuff's going to be treated as a used car if it's more than a year old. So fortunately, that problem is being resolved. But I would say that's another brand where, again, it's been like Nissan. It's never been a leader, right? I mean, Chrysler in this country was always third behind Ford and General Motors. Nissan's always been third behind Honda and Toyota in Japan. But we have seen these stores make a lot of money, particularly if the dealer is good in used vehicles, because there are a lot of units that are out there and the vehicles break. So the service business is really good on Stellantis product. So it's going to be a good business model. And given how far profits have fallen for this brand.
Can you give us some more detail when you say Stellantis profits have fallen? Like any absolute numbers here that you can share?
Well, I have the anecdotal information. I would say profits have probably fallen from the peak down below where they were before the pandemic happened. So if profits more than tripled for Stellantis dealers from 19 to call it 21, I think they have gone all the way back to where they were in 2019 and probably even below that level because of this excess inventory. So it's been a credible roller coaster for Stellantis dealers, but it's really been 2 straight years. I think it's 9 quarters in a row of sales declines at Stellantis. That's brutal. The market in the fourth quarter or for the year, I think, was up 12%. So if you're going down and the market's going up 12, you're losing gobs of share, and it's not that easy to get it back.
9 quarters in a row of new car sales declines.
Yeah.
That's massive.
Yeah.
I want to ask you about a brand that we spoke a lot last time. Do you know who I'm thinking about?
I can't remember. My brain's not that sharp. What was it?
The F word.
Ford.
What's up with Ford? I mean, is it too early? Is it too early to even consider, dabbling in that space and, looking at Ford? Like, I mean, they've been walking back on certain decisions and things and whatnot, but give me your overview on Ford. Where's Ford at nowadays?
I think you can go back to Ford now. I think that Mr. Farley,
Wow, that's all to that extent, huh?
Yeah, I think it's time because I think it was 2 years ago when Mr. Farley went said we're going all in EVs. I'm breaking my company up into 3 parts: the EV part, the ICE part, and the commercial part. And I'm going to run the EV part because he was convinced that EVs were going to become the company's future. And last year, I think I read they lost $5.5 billion in EV division. So if I'm Bill Farley and or Jim Farley, and I want to keep my job, and I'm running the division that lost $5.5 billion, I probably want to get out of that chair and go back to the division that's profitable, right? So I would say the F-150 Lightning, I don't want to call it a disaster, but when dealers won't take that vehicle on trade, it's a flop. And dealers won't take that vehicle on trade because they don't know what it's going to be worth tomorrow, because they're afraid that Ford will put incentives, higher incentives on the new 150 Lightnings to sell them. So now that I think Ford is realizing that EVs are not what its core customers want, which to me is amazing that they didn't know that beforehand. I mean, I think we talked about those dealers in the northern part of our country that customers bought a Lightning, they hooked up their trailer with the snowmobiles, and they wanted to go up to the cabin for the weekend. They like were petrified of running out of juice and being by the side of the highway overnight, in sub-zero temperatures. So all those vehicles came back from those customers. I've seen two Lightnings, maybe ever. And I live in a big metropolitan area. I just don't see them. I think they're great tailgate machines, because you can open up the front. There's a huge place where the engine used to be that now can be where your cooler beer goes. And in the back, they have all the outlets where you can plug in your TV and your grill and your stereo and everything else. But it seems to me that Toyota wins again when they talk about, the hybrid strategy is the way to have electrification in a vehicle. So I think that dealers have been suffering with the EV products they've had, the Ford Mach-E's, the Lightnings, the whole discussion that it was going to be an agency model and customers were going to order vehicles directly off the Ford website and you could bid to deliver them if you're a Ford dealer. I think all that futuristic dreaming is going out the window. I think it's going to go right back to where the traditional Ford customers buy traditional vehicles from the dealer one at a time, plus the commercial aspect of Ford, which is one of its strengths, is that many of its products are used by people not for personal transportation, but for a living. They're the roofer, they're the exterminator, they're the contractor. That vehicle is in production for them to make money. So they need it to work. They don't mind bringing it back to the shop. If there's any issues with having it running, they're going to put a lot of miles on that vehicle, tires, brakes, alternators, engine rebuilds, etc. So for that business, I kind of like Ford again. I think a lot of the stuff that anti-dealer or threatening dealer, I think it's going poof. And they're going to go back to what made that franchise so strong in the past. General Motors is kind of the same way.
Yeah, I was going to say on Ford, there's a line that my dad always says that, I love. And he says, life and death is at the power of the tongue. I feel like it's tough after, you let the genie out of the bottle to kind of, earn back trust from people so quickly. How do you actually see that impact valuations, right? So they may have, cooled down and they're doing the right things to potentially appease shareholders, right? But is that reflective yet in potentially, and I say potentially, rebounding valuations for Ford dealerships? Or are you still seeing a market that is somewhat frozen on the Ford side?
I think that values have come back. I'm going to do some quick math while you talk about this. We had two Ford dealerships under contract the day that, or three actually, the day that Mr. Farley said, hey, here's our new plan. If you want to be a dealer with us and sell EVs, you have to do all this stuff. And it added to be like $1.6 million per dealership. That's a lot of money. That's $5 billion worth of investment, I believe, required by Ford dealers to be able to sell vehicles. Two of our deals broke instantly. The buyers were like, $1.3 million, $1.6 million. That's on you, seller, to invest that. That's coming out of, the deal. And the seller's like, no, that's going to give you all these great EV products to sell in the future. Nope. So two deals broke right away because of that. And we didn't publish it because we weren't sure, what the long-term impact was going to be. We weren't sure if they're going to stick with that. Since that time, many Ford dealers did make the investments. I think some of them are a little bit upset they made it because the return hasn't been there yet. Eventually, they'll get a return. But now, those requirements have been watered down, right? And dealers in some cases in small markets just won't do them because they're not going to sell enough cars to justify it. But I think that a lot of dealers have been in their chairs a lot longer than the CEOs of these automakers have been. And so they've seen management come and go. They enjoyed good times and bad times. And so I think for many of these dealers, they may be sitting there some chairs longer than the CEOs. So they may not want to buy a Ford store if there's a 1.6 million requirement, but when that dissipates and that goes away, they're going to step back in. And we just sold a Ford store earlier this month for a decent value. It was up in New Hampshire. And the buyer there was excited to get it. So I think that the worst risks of being a Ford dealer are maybe behind us. Probably the same thing is true with General Motors. I mean, what a flop their strategy has been too. Remember the Hummer? Remember how that money they spent on the Super Bowl? Was that 3 years ago? I've seen two. And I have to imagine they're losing gobs of money each one they sell. So just this week, the EPA dialed back its requirements for when vehicles have to be electrified. That's going to keep coming because otherwise the voters would vote out these politicians that are voting for green policies that are further ahead than they are. So I feel like it's safe to buy a Ford store again. I feel like it's safe to buy a General Motors store again. The strike is over. I think we're locked down for, is it 3 years, Yossi? Do you know how long these contracts are for? 3 years, 5 years? I can't remember.
Don't have exact date on top of my mind now.
Yeah. So I think the bad surprises are in the past. And I mean, we're selling a Ford truck franchise now. They don't even have, the main consumer products. It's just kind of the Ford medium duty trucks. And the blue sky value is really strong. So I think if it's got, diesel or gas trucks that you can sell in this country, you're going to do well. And so dealerships are selling again.
Before we wrap up and transition to macro, I'm curious your take on Chinese manufacturers, right? This is again another topic that's percolating and lots of questions. Are dealers asking you about this? Do you foresee in 5 years are we going to see a Chinese dealership down the street? I mean, what's the deal here with the Chinese car manufacturers?
It's a great question. Potentially that is a great threat to the franchise system if their vehicles are well designed and priced lower. Consumers will swap to a Chinese car for saving $200 a month. I've talked to enough dealers to be convinced of that. There's not going to be this like, oh, we're having conflict about China because China might take the user data from TikTok. Like if you can save $200 a month as a consumer, you're going to buy that Chinese product, right?
100%. I totally agree with you. If you don't think that, you need to get into retail a little bit more, right? Like I did a tweet maybe a couple months ago, and I think it was like, newsflash, people don't care where the car is made, right? The average consumer simply wants four wheels and Apple CarPlay. That was the tweet. And the point was that it was exactly what you were just saying. It's like you're living in La La Land if you think that there's going to be a car with a different emblem here on the roads, and the average consumer who's living paycheck to paycheck, who maybe has no savings, debt, or like 30 days of savings, is not going to, say, give me that Chinese car. It's cheaper. I mean, you're in La La Land if you don't think that's going to take off.
100% true. I mean, I look at the German brands. Like a lot of Americans died in World War II fighting the Germans. In the 1950s and 60s, their cars came over and people bought them. The Japanese, same thing true in the 60s and 70s. Tens of thousands of American soldiers died, and now their kids are driving them.
And to be clear, like I commend people that their values are more important to them, and maybe they say, nope, I'm only buying American made or X made or Y made or Z, like whatever. But the practical reality of the American consumer is that is just not going to be the case. So it's a threat. It's a big threat.
So I have a dealer friend that has two BYD vehicles in their driveway right now. And they said one is like an RX 350. It's beautiful, drives great, handles well, styling is just the same. It's $39,000 is the price, the estimated US price, versus I'm guessing an RX 350 is in the 60s, be my guess. I forget what the other model he had, but he said it's equally nice, beautiful car, etc. Now, I think they're trying to figure out how to enter this market. Are they going to set up a retail network? In which case, it could be a good opportunity for franchise dealers that have capital, have experience, know the markets, etc., and would welcome the ability to sell a well-made vehicle made in China. If it takes share, will it threaten all the existing ones? Yeah. Just like Tesla took share. But again, dealers can adopt. You're not just selling or adapt. You're not just selling new cars, right? You're selling used cars, and you can sell used BYDs. You can service cars, you can fix cars that get in accidents. So if they come and it's a lower priced vehicle and it goes through the retail network, the franchise system could be good for the dealer community overall. Now, I have a feeling in the politics of this country today, given all the anti-China rhetoric, which frankly, a lot of it's deserved. I mean, they've been terrible thefts of intellectual property, quite hypocritical. Like when U.S. companies or German companies or Japanese companies wanted to manufacture or sell in China, they had to give away half of their company to a Chinese partner. So will that happen here? I don't know. But I think they'll be successful if they come with a product that is as reliable as it is priced, right? You don't have to have a Toyota reliability if you're charging half the Toyota price or one quarter or three quarters of the Toyota price. So is it a risk or is it an opportunity for franchise dealers? Yeah, if they want to come in through a direct consumer model, that'll be a risk. But I can also imagine the challenges of them setting that up and getting this vehicle serviced, because it's not going to be that special. Like Tesla's special. People will wait a couple weeks to get their Tesla repaired. I'm not sure you're waiting a couple weeks to get a low price vehicle repaired and being happy about it, because you need that car. The Tesla might have been your third car or fourth car. But if you're buying a BYD, that's probably your primary source of transportation.
Yeah, and the Chinese are very methodical, and they know, hey, this is already going to be something that's a bit confrontational. I would be shocked if they did not come into the US under the dealer network, right? They don't want to come in and make enemies. They already know this is going to cause a bunch of hoopla, right? This is you know, it's the elegant way to do it, where they're kind of coming in with the crowd. They're on the dealer side. Dealer lobbying is on their side. I mean, I would be, again, that's my personal opinion, and I'm no expert at this specific topic by any means, but that's just my hunch based on what I know. So before we wrap up, Alan, I want you to bring us full circle. I mean, this has been amazing discussion, and just really doing a brand deep dive. It's just, lots of changes here in the last couple of months alone. What is next for our industry, right? Like, give us your outlook for the remainder of the year, how you see the overall market, and where do you think we're headed?
I think that life is going to return to quote normal, where dealers were going to have to go and sell cars again as opposed to taking orders. It's already happening. You can see that because the inventory is already built up. I think that dealers will continue to invest more in the fixed operations than they have in the past, because I think they're realizing that, hey, even if I make less money per car going forward because the supply is back, there's a lot of pent-up demand for service work. And so we see people building bigger service departments than they used to, and promoting that. I think there will continue to be a search for technology that makes dealerships more efficient, so they can do more with fewer people, or they can reach more eyeballs with fewer dollars. So I think the business will. I mean, I spoke with Daryl Kinningham, he's a CEO at Group One, which is one of the largest dealership groups in the world. They've got, I'm not sure how many stores, probably over 200 dealerships in the United States and in England. And he says, we're kind of like a 2.5% net to sales business. I can't remember if that was exactly meant, but so for every dollar of revenue we make, we keep 2.5 cents. That's a really low margin business compared to almost any other industry. But the average dealership today might do $80, $100 million of revenue, and some do several $100 million of revenue. So in his minds, if he can take a 2.5%, if he can save half a cent a year, he's going to improve his profits from 2.5% to 3%. So he's going to improve his profits by 20% by just nibbling.
Volume business.
Yeah, you can just nibble a little bit on the edges. So you spend a little bit less money on a car advertising it because you had a better message that resonated better. If you have vehicles that turn a little bit faster because you ordered the right vehicle and you price them correctly, that's something technology can help with. It's not going to sit on the ground and cost you advertising dollars and floor plan dollars, and then you have to discount to sell it. So I think that technology is going to continue to play a big role in our industry. There are dealer groups that also believe that larger scale will help them save money. So if I go from 2 stores, which is the average dealer has 2 stores today, I go to 5 stores or 10 stores, maybe I don't need as many accounting people per store. Maybe I can advertise more cost effectively so I can spend less money per car. Maybe I can attract and retain better talent because they'll say, hey, this is a growing group. If I just go to the guy that's got 1 store and he's 70 years old, he's not going to buy another store. If I go to the guy who's 50 and he's got 5 and he just bought a store and he wants another store, I'm going to have a shot to be that GM partner on his 7th, 8th, or 15th store. So I think people that are growing, there's a couple terms that I've heard that I like, that I remember, and I share them. Maybe I shared this one already, but there's a dealer named Sam Swope. He had a phrase, when you're green, you're growing, and when you're ripe, you're rotting. When you're green, you're growing, when you're ripe, you're rotting. So those groups that are growing, in my opinion, attract talent through their acquisitions. When you buy a dealership and you have 70 people, 100 people working there, there's going to be some talent in there that you didn't have in your company before. And there's excitement, there's energy, there are things that are happening. People notice that. They want to be a part of something that's growing and vibrant and healthy. And it creates more opportunities within the company. So the folks that are out there working to grow their groups, in my opinion, that's a good use of their time and capital. Because every time you get a little bit bigger, in my opinion, you get a little bit stronger, a little bit more diversified, whether it's just geography or whether it's by franchise or whether it's by talent. You've got more. You've got more ability to take advantage of the good times, and you've got more strength to weather the tough times. So we're big fans of people, if they have the motivation and the capital and energy to use that to grow versus paying down your mortgage or buying a 5th property, or a bigger jet or a bigger boat. I would take that capital and put it into another dealership, maybe a Mazda store, maybe a Stellantis store. Maybe when that Toyota store comes in, that's around the corner from you, you've always wanted, you say, it costs a fortune, but it's a once in a lifetime opportunity for me to have that brand in my group, and I'm going to grab it. So those are things that I see leading dealers do. Now, at the same time, like I had this great conversation with Rita Kay. She's got 12 dealerships, and I asked her, are you interested in growing? Nope, I don't want any more. I'm in a sweet spot. I've got $2 billion in revenue. I've got world-class people working for me. I'm really now about quality and opportunity. What do you mean?
Efficiency.
Yeah. What do you mean by that? It's like, well, on the quality side, I want to be the highest, the best sales that I can for my franchises. And she wears a lapel that says #1. So she's driven to be the #1 Honda store, the #1 Volkswagen store, the #1 Kia store, the #1. Like, she wants to be #1 in all of her brands, but she also wants to provide opportunity to her associates and to people in the community. And I learned that she and her husband have raised over $125 million over the years for the Boys and Girls Clubs of Broward County. That is making a difference. So for some people like Rita, she doesn't need more dealerships. She's happy. She's making, sure, I know, plenty of money. She has no interest in selling. She loves what she's doing. She got kids in the business. One day she'll have grandkids in the business. But for her, she wants to get better with what she has. So it's not always about growth. Her green and growing is getting better at what she owns. She says, my buildings have the capacity to sell.
That's a great way to put it. Yeah.
Yeah. So it doesn't have to be acquiring new businesses, but getting better with the ones that you have is also a great strategy in terms of development and expansion.
Well, that's a great way to wrap up. I love that story. And Alan, always a pleasure to have you on. Always something new happening. So it's never a dull moment.
Yeah, well, congratulations on all your continued success, USC, and you've come out from behind your avatar, I guess, and we all can see your smiling face.
I remember the first time we recorded together. You're like, you stumbled on my name. You're like, Yossi, a car dealership guy, right?
Yeah, well, I can say your name now, right?
Yeah,
it's okay.
Yeah, we're good now. I love it.
Right.
All right, Alan, always a pleasure, my friend. Thanks for coming on.
Great talking with you.
All right, hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.